also about how the businesses will shape up from here on. But let's move on. There's lots happening on the real estate front. Today we're going to talk about REITs. First, we'll tell you what is a real estate investment trust, popularly known as REITs. Sonal is here to decode how they work, how investors can earn money through the REITs route, and then we'll get some guests on board as well. Sonal, over to you.
Thank you so much for that. Well, of course, residential real estate has been doing very well. But one asset class that we don't talk about so often in the real estate space is REITs. So let's first understand what REIT really is. It is a company that owns and operates income-producing real estate and owns many types of commercial properties or real estate offices. Now, it is from office buildings to hotels. So simply put, it resembles a mutual fund with real estate as the underlying assets. They invest money in completed and revenue-generating assets and developmental properties, mortgage-backed securities, corporate debt of real estate sector. So how does an investor earn money in this case? REIT operates via an SPV or special purpose vehicle, and the trust receives dividend and interest from the SPV. REITs also earn rent and capital appreciation, which is then distributed via dividend to the unit holders. One way to invest in REITs is via listed players. So there are three in India. We have Brookfield REIT, there is Mindspace REIT, and there's also Embassy REIT. Now, how are the fundamentals of the underlying, that is the commercial sector, set up? Vacancy levels, they have been increasing since COVID. That is according to data from ICICI Securities. For Grade A assets, it has risen from levels of 13.8%, that was in Q2 of calendar year 2020 before COVID, to around 17%. That is the figure right now. And this has been on an uptrend. However, for the listed players, it is not as high as it is for the industry. For Embassy REIT, it is around 13%. For DLF, around 12%. Mindspace REIT and Brookfield REIT have it at the industry levels of around 17 to 18%. However, going forward, the management commentary is very positive. REITs expect to reach pre-COVID occupancies of 90% by, say, March to June of 2023, and rental collections have been at 99% over FY21 to Q1 of FY23. Companies are also seeing healthy re-leasing spreads with contractual escalations despite COVID. However, fundraising via REITs has not been very encouraging. In India, FY21 saw an influx of around 14,300 crore rupees, which compares with nil amount in FY20. It dropped down to 950 crore rupees in FY22, and so far in FY23 till August, it has not seen any fundraise via REITs. Just leaving you with a data point, while listed REITs have higher distribution yield between 5.5 to 6%, generally wanted to highlight that rental yields in the country are not very high. It is low as per the data by 99 acres, 2.4% for Mumbai, 3.5% for Bengaluru, Ahmedabad has it around 3.2%, and it is low for other cities as well, which compares with Asian countries' rental yield of around 3.5 to 4% and European countries with a rental yield of 4.5 to 5%.
Okay, very, very helpful data. So a low rental yield gives rise to the question that does it make more sense to buy the commercial or residential property, or does it make more sense to invest in REITs, right? So we have a couple of gentlemen joining